right, if you're trying to figure out the markets today, just forget the earnings reports for a minute. Forget the economic calendars. Because right now, there is only one story that truly matters, and it's all about some very high-stakes brinksmanship playing out in the Middle East. Geopolitics isn't just a headline anymore, it's got its hands firmly on the steering wheel. So let's break down exactly what that means for your playbook. So here's how we're going to tackle this. First, we'll dive into the geopolitical showdown that's causing all this turbulence. Then, we'll see how global markets are reacting. After that, we'll zoom right in on the surprising comeback in the Indian markets. And finally, we'll get tactical with the key levels you absolutely need to be watching today. Okay, so first up, the main event. The entire market narrative right now is being dictated by this tense back and forth between the US and Iran. And let me be clear, this isn't just some background noise. It is the primary catalyst for every single move we're seeing. And the language being used? It's sharp. So after Iran responded to a 15-point U.S. peace plan with their own 10-point proposal, President Trump's reaction was immediate and blunt. Not good enough. I mean, that one phrase tells you everything you need to know about the current mood. It signals that a simple, quick fix here is probably off the table. And this really shows you just how far apart the two sides are. On one hand, the U.S. wants strict compliance, verification, deadlines. On the other, Iran is demanding a permanent end to any conflict, all sanctions lifted, and security guarantees. They've even offered to reopen the critical Strait of Hormuz, but for a fee. The gap between these two positions is, well, it's massive. And why does that one strait matter so much? Because a staggering 20%, 1/5 of the entire world's oil supply flows right through it. It is the single most important choke point for global energy, period. And it's ground zero for this whole crisis. This number? This is why Wall Street, the Wall Street, and every other financial hub is glued to their screens. So the big takeaway here is this. We're not just going to snap back to the old normal. The market is now pricing in this new reality. What does that mean? It means higher baseline prices for assets like oil and gold, because investors are demanding more compensation for all this added risk. We are in a new, more expensive normal, and that's the world we have to trade in. So how exactly is this tension playing out across the board? It's creating these huge ripple effects. Let's take a look at how different assets all over the globe are pricing in this new risk. I mean, this chart just captures the reaction perfectly. It is a classic flight to safety combined with a supply risk premium. You can see oil prices are surging because of supply fears, Brent over 110, WTI over 113, while gold is holding firm, doing exactly what it's supposed to do, acting as that traditional safe haven asset when things get messy. The theme here couldn't be clearer. It doesn't matter if you're looking at equities, currencies, commodities, every single asset class is trading on geopolitical headlines first, and economic fundamentals a distant second. Yeah, we saw U.S. equities nudge a little higher on some thin optimism for a ceasefire, but the real winner has been the U.S. dollar, which is soaking up all those safe haven flows. Okay, now let's narrow our focus and talk about India, which had a really fascinating reaction. The market did its classic morning drama, a dip driven by those global fears. But what happened next was the real story. After that initial scare, the Nifty 50 just came roaring back. It rallied over 1%, 1.12% to be exact, to close at 22,968. That's a pretty powerful display of resilience, and it shows the market's ability to shake off global jitter and find its own momentum. So what lit the fire for this impressive comeback? Well, it was a cocktail of things. For sure, those fragile hopes of some diplomatic progress in the Middle East helped, but domestic factors played a huge part. We got strong loan growth updates from banks, which really calmed nerves. Market breadth was overwhelmingly positive, and bond yields actually eased as investors started pricing in a tiny chance that maybe meetings would replace missiles. The Indian rupee, on the other hand, is telling a totally different story. It was caught in this massive tug of war. On one side, you had importers rushing to buy dollars to hedge against risk, but on the other side, you had traders unwinding arbitrage positions. In the end, these two powerful forces basically canceled each other out, leaving the rupee to close almost perfectly flat. Okay, let's get to the so what, the actionable part of all this. With everything we've talked about as the backdrop, what are the key technical levels that traders are laser focused on right now? This is your playbook for today. First up, the US dollar index, or DXY. As you can see, that wall at 100.25 is proving to be some seriously strong resistance. It's like a ceiling the price just can't seem to break through.
So the tactical view is still buy on dips, looking for chances to get in near that key support level of 99.64, where we expect demand to really pick up.
Now, for some context here, we recently got the US ISM Services PMI. And yeah, it did fall a little bit, but look, any reading over 50 still points to expansion. So even with a small dip, the data is still signaling underlying strength in the US services sector, and that's helping to prop up the dollar.
For the euro and the pound, it's pretty much the same story. Sell on the rise. Both of these pairs tried to push higher against the dollar, but were met with a wave of selling pressure. For the euro, the key resistance you've got to watch is 1.1544, and for the pound, that key ceiling is sitting up at 1.3265.
And the big event for these two today is the release of services PMI data from Europe and the UK. That said, expectations are already pretty low, so it would take a really big surprise to move the needle, especially when geopolitics is still running the show.
Moving on to dollar-yen. The pair is once again testing that absolutely critical level of 159.77. A decisive break above this could really open the door to 160.55. And you know any move above 160 is going to spark a whole lot of noise about intervention. Support, meanwhile, is sitting down at 158.93. And man, the pressure is really mounting on the Bank of Japan. We just got some very bleak household spending data. To make matters even worse, the Japanese 10-year bond yield has now crossed 2.40%. This just adds another layer of complexity to what is already a super difficult position for the BOJ. All right, for the Indian rupee, the weekly tactical view is still buy on dips. The ceiling to watch is up at 93.40. And on the downside, traders are watching two key support zones where buying interest could pop up, first at 92.90 and then a more pivotal floor way down at 92.57.
And finally, the Nifty 50. After yesterday's really strong close, all eyes are on that key resistance level of 23,083. Now, if the market does pull back, look for support first in that zone between 22,872 and 22,762, with a stronger floor below that at 22,622.
So the bottom line for the Nifty is this. A clean, decisive break above that 23,083 level could be a major bullish signal. It could mark the start of a new, less bearish phase for Indian stocks, which makes it the one level that absolutely everyone is watching. And all of this leaves us with the big question for today, doesn't it? We have a full slate of important economic data coming out of both the US and Europe, but in a world where every single asset is being driven by geopolitical headlines, will any of that data even matter? Something to think about as we head into the session.